Hello class, this is Brian from financialtrainingschool.com and welcome to GT119 Moving Averages. So let's start with some background info. Averages, without getting too technical, basically describes the middle or typical values in a data set. For example, if you had a room full of 100 people with different incomes, the easiest way to assess the middle value is to add up everyone's income, then divide the total by 100. This yields the mean of the data set. This measure, however, is not very useful for fluid data sets where data is constantly changing. For example, using the same room of 100 people with different incomes, if each end of the room had a door and as one person walked in while another person walked out, you'd have to recalculate the average each time. This is essentially what a moving average is, and when you add it to your charts, the moving average fluctuates up and down as new price points appear. In addition, the number of entries in a dataset can vary as well. In my example, I used 100 people, but you can have any number of people in the room. You can have 200 people, 50 people, 1,000 people, whatever number you want. The same goes for trading as well. Usually, institutional traders use a period of 50, 100, or 200. And for those of you wondering, the period is what your chart time frame is. E.g., a period of 50 on a 5-minute chart means it calculates the average of the past 50 bars. Now you're probably wondering, why is this important? Well, you can compare short-term and long-term averages to see changes in trends based on price fluctuations. And how moving averages fluctuate is simple. If you add a value below the average, it will drag it down. If you add a value above the average, it will drag it up. So continuing my example from before, let's say we only look at the past 50 people who entered the room. So originally with 100 people, let's say that a room average income was $75,000. Now looking at the past 50 people only, we find the average income among them to be $20,000. This shows that the trend of new people coming into the room have an overall lower income than the people currently inside the room, which weighs down the average. Thus, the short-term effects show a declining average income. Applying this same thought process to trading, you can compare the short-term trend against the long-term trends to see what might happen in the immediate future. The biggest indicator occurs when they cross up and down, and I'm talking about the moving averages. So for example, if the moving averages are sloped upwards, that means they're all pointing upwards, it shows that price is dragging the price up, which shows that there's an uptrend. But then if one of the moving averages starts to slope down and crosses the other one, then short-term effects might show that there's a change in trend coming up. So as far as customization goes, when you're adding these to your charts, you have basically two options. The first is you can pick the period of your choice. As I mentioned earlier, 50, 100, or 200 are the typical periods for institutional traders. Usually, only retail traders focus on the non-round numbers, such as 13, 20, 26, 55, 144, etc. Secondly, you can use a simple or an exponential moving average. Simple just simply measures the moving average for the past X number of bars with equal weight for each bar, whereas exponential puts more emphasis on recent bars to give them more weight due to being newer. I suggest you play around with both SMAs and EMAs and put both on your charts to see which ones you like. Specific strategies on moving averages will be saved for the other series. Before I end off this lesson, I'm just going to switch to free stock charts briefly to show how to add moving averages. So here we go, this is the Euro USD daily chart, and we're just going to add the indicators now. So you go to click add indicator, scroll down to find the moving average, pick price history. Now it's blue. Click on this blue tab here, click edit, and let's just change the color to something easier to see, white, and change the width so that's easier to see. And let's say we start off with a 50, so this is a period right here that you can change, and the average type, which is simple. We're going to leave it like that, and this is the last price. Most moving averages are based on the last price. Some people use the open price, but I use the last price. So just click OK, that's the 50. So now let's add another one, just so that we can compare short-term and long-term. So let's add a 200 EMA. So 200, and change this to yellow, change the width, exponential, and here we go. So this is what it looks like. This is just two basic moving averages. As you can see here, when price crossed above the moving average, it started to drag the moving average up because it's weighing it up. Same thing here, as soon as it got above, this part is sloping downwards, but here starts to turn. So I'm not going to talk about specific strategies here. That would be safe for the other series, but that's it for this lesson. Hope you guys enjoyed it, and I will see you guys next time.